Hello everyone. Welcome to the MNP Spring 2017 Agricultural Industry Update webinar. My name is Victor Kruger and I am again the host for today's session. I am a Senior Vice President of MNP Ltd, which is the insolvency and restructuring arm of MNP LLP. MNP is the 5th largest professional services firm in Canada with offices from coast to coast. MNP is also the only professional services firm with a dedicated farm management consulting services group comprised of professional agrologists and consultants who come from extensive agricultural backgrounds. In every ag insolvency engagement, we in the insolvency area bring in our farm management consultants to provide us with expert advice as to a specific situation and, if necessary, to be hands-on in a formal administration. Today, as in past webinars, I have the privilege of introducing Jonathan Small as our speaker. He will provide an update from the previous 6 months on the major sectors of the agricultural industry. Jonathan is a partner in our Red Deer office and a member of our farm management consultancy group. He has a Bachelor of Science degree and has a professional agrologist designation. During the presentation, please ask your questions in the Q&A button at the top left-hand corner of your screen. If time permits, we will try to answer your questions at the end of the session. Otherwise, we will contact you later to respond. Jonathan, we look forward to your presentation.
Hi, good day everyone. I was about to say good morning, but I'm conscious that we've got people from one side of the country to the other, so for some of you it's afternoon. I'm sitting here not in Red Deer, but in a very wintry Grand Prairie today, so they're having second winter up here, and I might even touch on that because we have an interesting situation up here. So without more ado, I'm going to skip through the first couple of slides. You see there the sectors on slide 2 that I'll be touching on today, and I'll work my way down to wineries and hopefully get you all better informed. So without more ado, on crops, I think one of the features, we touched on this last time, the situation was just developing when we met in November. In fact, I think as we were delivering the last one of these, there was a great many combines still at work in the field, and a lot of last-minute crop was harvested at that point. But nevertheless, for quite a lot of farmers, there's in fact about 2.5 million acres in all, mostly in Alberta and Saskatchewan. The first of 2017's 2 harvests is underway for some of these guys. I don't suppose anybody's harvesting in the Peace region today, and quite a lot of those 1.1 million acres in Alberta are up in this region, and I'll see a bunch of those as I drive north after this webinar to Fairview. So for the most part, we don't really know much about the quality of this crop, but we're not expecting it to be good. For the most part, the grain companies and the elevators have said they're not interested in buying it. Quite likely it's going to be quite badly contaminated with rodent droppings and so on, even if it hasn't weathered badly. So it remains to be seen, I think, what farmers can salvage from that. So roughly 4.5% of the crop in Alberta is yet to be harvested, and most of that will be north of Leduc. Very little around my hometown of Red Deer, and virtually none down south. Saskatchewan's about 1.3 million acres. That's about 3.5%. A little bit in Manitoba. Moving on, I think the big crops of soya and corn around the world are weighing pretty heavily on the markets. The known carryouts and the anticipated carryouts on both of those crops are very high, so that's going to keep a lot of markets pretty bearish. So wheat and those related grains and so on, we expect that those markets will be bearish. On the other hand, canola has rallied and continued to rally, and if anything, the outlook for canola is probably quite bullish, which is encouraging. Meanwhile, land prices, just looking at the FCC report for 2016, shows that land prices continue to somehow defy gravity. So Canada as a whole is up close to 8% in 2016, further underlining the attractiveness of that asset. And to put that a little bit more into context, PEI actually led the way in 2016 with double-digit increases in value, with Alberta was a mere runner-up at 9.5% increase in land prices. Meanwhile, at the other end, New Brunswick came in last at just 1.9%, and Ontario next to last at about 4.4%. So still some very attractive price gains on land, which helps a lot of balance sheets. I think the other thing that we're watching is the recent announcement on the federal consultation on grain deferrals. Obviously, farmers being able to file their taxes on a cash basis, many of them are in the habit of delaying banking their grain checks, which harks back, I mean, that regulation harks back to the Canadian Wheat Board's days, and the federal government's rationale for having this consultation now is that, well, the Wheat Board is gone, do we still need that regulation? Clearly that, if that benefit were lost to farms, that would have a pretty profound effect upon the tax situation and perhaps the cash flow behavior of a lot of farms. So we're watching that one closely, and as a firm, I'm sure we'll be trying to get involved as closely as we can with that consultation to look after the interests of our clients. So watch that space. That could be interesting. Next slide, moving on into dairy. This is a super buoyant sector right now. Somewhat surprising, but the market, the dairy market has been growing quite rapidly. Huge and increasing demand for butterfat is a key driver in that nationally, and some of you will remember the butter shortage last year, which is unheard of, but that was symptomatic of what was underway. So across Canada, as a generalization, between additional quota awards and the award of a great many incentive days, we've seen something like a 12% increase in available production, a lot of it in the form of quota. And if I put that into context, just to take Alberta, for example, since January 1, in the past quota year, I should say, Alberta dairy farmers have been awarded 7% more quota. If I put that in context, on a 100-cow herd, that's about $300,000 of additional quota has landed on their balance sheet, and they've got incentive days, a great many incentive days on top of that. So the other farms, or the other provinces in the Western Milk Pool, BC has had an additional 8% quota, Saskatchewan 6%, Manitoba an additional 12%. And we're at the point where, at least anecdotally, some producers are reporting it's going to be a struggle to fill all of this extra quota and the incentive days. And so I think from an industry perspective, we might expect to start to see some significant expansion plans coming down the pipe as farmers respond to this additional quota and the opportunity that comes with it. So once again, watch this space. Meanwhile, of course, CETA has now been ratified. That's the European trade deal. So what that means for dairy producers is that'll probably take a little bit of the shine off a generally very good outlook in dairy, with probably between 1 and 2% of the Canadian market now open to European fine cheese imports. So remains to be seen, I think, whether we really detect an effect within Canada. Of course, TPP does not go ahead, at least not in its present form, so that concern has gone away. But of course, now we have new NAFTA to worry about, and not surprisingly, both in the dairy sector and in the poultry sector in the U.S., those producer groups, those producer organizations there are lobbying very hard for new NAFTA to seek changes in our supply management situation. So I'm not sure that necessarily the disappearance of TPP could be hailed as good news for supply management sector in general, because we now have a new and fairly unpredictable president in the U.S. who at least at this stage is pledging to renegotiate NAFTA. So we'll see what happens. And of course we need to watch what's going on in Canada with the Conservative leadership race. I'm sure we could debate this forever, which is, who's the front runner and so on. But Mr. Bernier, for sure, is up there and looks like he's certainly amongst the front runners, and he has very squarely come out against supply management. And one wonders if he were to ever be Prime Minister in a trade negotiation, where exactly supply management would stand in that situation. So another area of uncertainty. The sort of internal Canadian Free Trade Agreement, which was recently announced, does not affect supply management, so we're not expecting any real issues there to come out of supply management. It also doesn't affect alcohol, I'm sad to say. And then last but not least, I think the other big news in dairy has been the new ingredient strategy, which has been developed in order to counter the diafiltered milk and the milk ingredient issues I talked about last November, which is a long story, but the intent of the new ingredient strategy is to make, well, first of all, to give processors an incentive to invest in more drying capacity, to produce more dried skim milk and so on, and to make the pricing and the availability of that product and related products more attractive to processors, and thereby displace the imported diafiltered milk and milk protein products and so on that have been coming across the border under the guise of food ingredients rather than dairy ingredients. It's very early days, and I think there's probably quite a lot of concern in the industry about what's the overall impact going to be on milk prices. But early indications are that it's well supported and appealing to processors. So I think the next 6 months will tell us whether that story is how that story is going to unfold. So overall, I think outlook in dairy is quite encouraging. Next slide. Poultry, not a great deal of change. There's a few things we're watching on the poultry side. Obviously, prices and consumption continue to improve, as they have done, and the next slide will sort of solidify what I mean by that. So the outlook is steady to good, I would say. Significantly, consumer power continues to gain pace, as it will, as we predicted for a long time. Consumer spending power has an influence on our industry. So recently, Tim Hortons and Burger King have made significant moves on welfare, and saying that they've pledged to only buy chicken raised according to their welfare standards, which they've developed in collaboration with Mercy for Animals. What's significant in that press release to me is there was no mention whatsoever of any collaboration by the poultry producer organizations in the development of those standards, and I think that is a peril for all producers of whatever they're producing to not get involved in those kinds of regulations. But nevertheless, those are two major users of Canadian poultry, and they add to the growing list of corporations, food corporations and so on, who are demanding changes in the way that food is produced. Meanwhile, of course, in the U.S., we're watching that also, as I've already mentioned. The poultry producer organizations in the U.S. naturally look over the border at our market, and naturally, of course, we wouldn't expect otherwise, they are making representations to Donald Trump and his team for when they come to renegotiate NAFTA to get increased access to our poultry markets. It's not like they don't have access already, but certainly they want more. So that's the poultry. If I was to say anything, I think the outlook is still good. It depends on how long that NAFTA renegotiation takes and exactly what the bargaining chips are on the table when it happens. Next slide just looks at quite a telling slide, I think, this one, and it pays to just stand back for a minute. So the blue line and the red line, the blue line is beef consumption since 1980. per capita, per person, and the red line, of course, is pork consumption. And what you see is a 35-year, 37-year decline almost without remission, and an inexorable climb upwards by chicken. Now, chicken has not quite made up the lost ground. There's been an overall reduction of about 7 or 8 kilograms per capita consumption of meat overall, but beef and pork have been the big losers, and I think that's a lesson not just for the poultry producers and what the outlook is, and of course our eyes naturally tend to extrapolate the lines on charts like this, and we have to be careful about that because it doesn't necessarily follow that those lines keep going the direction they've always gone. But nevertheless, that's a 35-year trend which is hard to deny and has profound effects on the agricultural industry and where supply and demand is taking us. Next slide. So cow-calf, the cattle cycle, which I talked about last time, continues its inexorable path. The U.S. herd is rebuilding still quite substantially. What's interesting is the signal to rebuild has not really occurred in Canada, or it is delayed for some reason, and so we're actually seeing the number of heifers retained coming down, which is a precursor for declining cow herd in Canada. So Canada's not quite following the same path. Nevertheless, our prices follow the U.S. prices inevitably because their market is so large. But we see feeder prices. So feeders are the cattle that the sort of first stage of the fattening period. Fed cattle are or finishers obviously are the final stage. So feeder prices, that's calf prices effectively. So the feeder comes right off of the cow. Those prices remain significantly below 2015 levels, and although the trend is improving. Cow-calf gross margins, we're expecting to return to more of their long-term average. So we tend to see the long-term average for cow-calf gross margin per cow in the sort of $300 to $400 a cow range. That's basically the value of the calf less the cost of feeding the cow. There's a few other things in there, but basically that's a pretty long-term margin, and it doesn't vary much from producer to producer, which is interesting. Previous peaks in the cattle cycle were in 1996 and 2007. Our expectation, therefore, is at the moment is probably that next peak in the cattle numbers, and therefore trough in calf prices, is going to happen somewhere in the sort of 2019, 2020 neighborhood. Obviously, the cycle varies in length a little bit, but we seem to be heading in that direction. Meanwhile, so Canfax, who are probably the industry's one of the industry's key sources of data and market analysis and so on, are predicting that calf prices will continue to fall away from their 2015 highs of about sort of $300 per hundredweight, and are likely to cross below the long-term price of $200 per hundredweight sometime during this next 12 months. And typically fed cattle, those are the cattle coming out of feedlots, the finished cattle, typically they bottom out 1 to 2 years after the feeders. So the pathway, the outlook, I think, probably on cow-calf, and as I get to it, the cattle feeding industry and so on, the outlook is probably somewhat bearish. There will be producers. Margins are certainly coming back in the feeding side, as you'll see in a minute, but for sure we've got a less comfortable ride over the next 2 to 3 years in this industry. The next slide is a chart that just shows us the Canadian beef cow numbers. I've already talked about this and so on. In theory, expansion should come next in Canada, and possibly it will, but it seems to be somewhat delayed, and maybe it'll just fizzle. It easily can. Next slide, looking at feedlots. So we're seeing margins start to come back on the feedlot side. So The market has readjusted, I guess, although, of course, we continue to see downward pressure on consumption. We've already looked at that slide, and as the beef supply increases in the U.S., we'll see continued pressure on beef prices. And so the next slide, actually, if we just jump to the next slide, because a picture tells 1,000 words. So there we have. Now this is Alberta, but Alberta dominates the Canadian industry. So what's going on here really describes what's going on elsewhere in Canada. So the blue bars are the yearling steers. Those are the feeders. Those are the calves that come off the cows going through, first of all, their sort of 160 to 220 day backgrounding period, where typically their daily gains are fairly low, but you're building structure, building muscle groups and so on in those cattle, but you're not applying the finish. Margins, profit margins have come back in there, so we're seeing certainly some backgrounding lots able to pencil in a profit on those cattle, and that's that trend I was talking about earlier. And as we typically see, the finishers, the fed steers, that red line, that generally lags behind, and you can see a clear lag on that chart going back to 2013. And so our expectation is, Canfac's prediction is that we will certainly see profits come back into those finishing lots and that finishing process during the course of the next 12 months. Indeed, there's some anecdotal reports of some producers already able to pencil profits on cattle that they're putting on feed right now. So some encouragement. The loss of equity has been colossal. Not sure. I think Western Feedlots had just shuttered their operations when we did this presentation last time. But for sure, that was a very large player who finally decided that 16 months of losses was too much, and they bailed out. And there's no doubt we've seen some pretty savage effects on balance sheets on the larger feeder operations in the last 18 months or so, and it's nice to see that coming to an end. And obviously barbecue season is coming up, and that always helps, certainly on the more expensive cuts of meat anyway. So outlook probably better there, but of course, we've got long-term trends to fight against, quite deep-seated ones in terms of red meat consumption, and of course what's going on in the U.S. with a steady increase in the beef supply. As long as the economies continue to improve, beef consumption may take up some of that slack. So that's beef. Next slide would be hogs. Interesting here because what we've seen has been a bit of a surprise. The U.S. swine herd, of course, continues to expand. Their breeding herd's up about 1%. Their market, their finishing animals, that herd is up about 4%. Canadian trends have been the same, somewhat smaller percentages, but for sure Canada has followed the same path. Despite that steady increase in supply, and despite what the charts would tell us as in terms of the hog cycle, we've seen an unexpected rebound in Canadian margins during the fall of 2016 after our last presentation. And in fact, we have an unusual situation we don't see too long, which is that both on both sides of the borders, both the packers and the producers are profitable at the same time, and that's very welcome, of course. But it's interesting to see perhaps the reasons behind that. Obviously, the weak Canadian dollar is helping Canadian exports, which is adding a good floor to our market. But interestingly, of course, there's two quite sizable packing plants opening in the U.S. Midwest in the next few months. And the anticipation is that the increased competition for hogs, for shackle space, to fill the shackle space in those packing plants is going to continue to strengthen producer prices and so on. And so our anticipation is actually it's probably moderate to good in the hog sector. Meanwhile, we're also anticipating, because of actually my first slide where I talked about sort of bearish markets on a lot of the grains, that means the primary cost in hog production being feed. We're anticipating that feed costs, if anything, will come down. Obviously, protein prices are coming down with what's going on with soybeans, and that's going to help with the cost of production in hog production. So outlook probably, as I say, probably moderate to good. And I think the next slide, we see what's been going on. So you can see the various dips in the cycle there and so on, but although we've been trending back down, we weren't expecting to have that little green peak there, and we do, which is once again very welcome. Next slide, agri-food and more food and beverage processing. There was a theme here, gentlemen and ladies. It's been trade. It's been all about trade. It's still a very hot space, and I talked at length about that in November. None of those factors have changed. It's an exciting area. There's some very attractive margins to be made in this sector with well-managed operations, and the Canadian operations generally are well-managed. So with CETA now ratified, we're into a phase where a lot of Canadian food processing companies are actively studying that trade deal now and looking for the opportunities that it presents. One might say, well, could they not have done that previously? Why did they wait till now? But of course, as we've seen with trade deals, they can easily come off the rails. And so investing a lot of time and money in exploring these options before that deal was ratified would have been unwise. Anybody who did that in anticipation of TPP, for example, might be ruining their time and expense they put into that. So that's a developing story. Probably by the time we do this again, we'll start to, we may have some reports on some stories to tell about how Canadian companies are exploiting that opportunity. Meanwhile, of course, the Trump effect has also got a lot of Canadian companies nervous about new NAFTA. Obviously, exports to the U.S. are a major driver in this sector, not surprisingly. It's with such a huge market just across the border. And so, naturally enough, I think companies that are heavily involved in exports to the U.S. would be wise to have some concerns about how that might play out. Some are concerned about the U.S. Food Safety Modernization Act, which effectively has the buck stop with the first U.S. importer, right? So if there's issues with food safety from an imported product, the problem belongs not on the Canadian side of the border, where it's actually difficult to run cross-border litigation and so on issues like that. The buck stops now with the American company that imported that food, and so that's going to cause some issues, I think, we think, and is likely to impact some of the smaller Canadian exporters who don't have the resources to prepare themselves for those kinds of situations. So we're watching that somewhat carefully. Last but not least, of course, that low Canadian dollar is also got quite a lot of American food companies this side of the border prospecting for opportunities to buy capacity and enhance their profits in Canada, as well as sourcing some of their food products right here in Canada, and even therefore recrossing the border to the supply stores in the U.S. It will be interesting to see what their new president has to say about that, if it increases in scale or scope, but for sure there's some bargain hunters up here in Canada looking for opportunities to buy. So we're also watching for mergers and acquisitions in this space. Last slide, I think. We'll start with the best, or we'll finish with the best one, of course. So wineries. So I've already said the CFTA deal, the Canadian Free Trade Agreement, doesn't impact on alcohol in Canada, but currently a Supreme Court challenge, which is coming out of Eastern Canada. I forget which province it is. I think it's Prince Edward Islands or maybe New Brunswick. There's a Supreme Court challenge to the provincial regulations, which we're watching closely because that may have some impact and free up intra-provincial or interprovincial movement of Canadian-produced alcohol. Meanwhile, we're seeing a somewhat slow start to the season, to the growing season in wineries. Maybe a week or so behind normal. Not a major issue, but significantly the opposite of 2016, which overall was a very early season. Too early to tell what the yield will be like in terms of production and vintage, of course. supermarket story, those sales are still developing, and that's still very much a developing story, and I talked about it last time. Overall, though, wineries who get a huge amount of their revenue now, and many of them are very dependent on tourist revenue, are expecting another good tourist year. The Trump effect, both tending to keep Canadians bottled up in Canada and spending their money here, and of course the lower dollar tending to encourage U.S. tourism into the major Canadian winery areas and so on. So those wineries that do it, most of them do, are gearing up for another good tourist year of more direct sales and more traffic to their wineries. And last but not least, winery land prices have now finally recovered almost to their pre-recession levels. It was a sector that was quite badly hit in terms of land prices, unlike a lot of the rest of Canadian land. And we're almost back to pre-recession, so pre-2008 or 2009 levels. I think that's my final slide. If there's any questions, I'll take them now.
Hey, Jonathan, one question that I have is on wheat you say it's bearish, but what does this mean for prices in 2017 versus 2016? And I know that each producer is different, but what kind of range would you require for break even for these producers?
Well, the first question's easy. The second one is harder. So the first question, if I was to sum up the outlook for 2017, coarse grains, so if you like non-oil seeds, that's so the sort of major durum, wheat, barley, oat grains and so on, the outlook's probably for lower prices, if only because the carryouts are higher, so there's a lot more crop left unsold at the end of the marketing season, or we're anticipating that, and that tends to push down prices compared to prior years. So outlook, that's what we mean by bearish there. I think the break-even's really hard because it's going to depend on which of the types of grains, and of course in the end the yield achieved by the producer. But I don't think if I was to give a general answer to that, Vic, as best I can, we're not anticipating prices so low as to be below break-even levels, with producers who are A, managing their cost of production effectively, and B, who are getting normal yields. Obviously, outside of that, there will be exceptions. I mean, there's some guys who somehow can't make profits even when prices are good, right? They've got serious problems. But overall, it would be too early to say that the market prices are going to push us into losses, except in badly managed farms.
And just to continue on, or thanks, Jonathan, just to continue on the grains, how do the world crops look, and their effect then on Canada?
Well, of course, Northern Hemisphere, we've got a long way to go. I believe I've not seen any negative reports coming out of Europe in terms of overwintered crops and so on. So we've got no weather markets going on that we'd see that rallying prices and so on. Obviously, Southern Hemisphere, in our hemisphere, in the Western Hemisphere at least, those crops have been good. So as I touched on, corn and soybeans in South America were generally good. So we've got big supplies come from there, and we've got big carryouts in North America. So once again, no sort of major weather markets going on, but it's a long way to go yet. We've got a long way to go in the Northern Hemisphere before we've got combines rolling.
We have another question here for you, Jonathan. What do you predict will happen with land prices?
Well,
with the downtrend in cattle and grain.
Guys, you've only got to hold out the 10 or 15 FCC annual reports on land prices and so on, and see that what's going on in the agricultural economy in terms of production seems to have no bearing on what's going on with land prices. It'll slow down the land market sometimes, but we don't tend to have market events or production events that are deep enough or sustained enough to really seriously put a dent into land prices. So I don't think what's going on with cattle is going to seriously impact. You might get local effects, but my anticipation would be is that the trends will continue. Now, anybody out there, and I know we've got a lot of bankers on this call, anybody out there who's got inside information on what could be happening to interest rates, if there's an interest rate spike, that's what it will take, I think, to make a serious impact on land prices, right? It's the only times that I've ever witnessed it in my career is interest rate shocks to produce big holes in the land price market. So I'd still be pretty optimistic about land prices going up. I'm not going to predict the rate, but I'd still be pretty optimistic about land prices continuing to rise.
Thanks, Jonathan. We'd also like to thank everyone for their participation in this webinar, and we would encourage you to contact Jonathan with any specific agricultural questions or me regarding any insolvency issues. Our contact information is in the presentation. As well as an appendix to today's presentation is a further information about MNP, our farm management group, and some special situations where the farm management group assists us in the corporate recovery practice. This webinar has been recorded, and a link to the recording will be sent to each participant that is on this call, and will also be posted on our mnpdebt.ca website. Please feel free to forward the link to your colleagues, and we look forward to your participation in our fall 2017 webinar. So thank you, and goodbye. This webinar is now concluded.